Are we all together, please?
Yes, sir. But, sir, the lecture notes, has it been shared, sir? Please.
The lecture note is not complete yet.
Okay, okay.
Even without the completion of the lecture notes, as we are updating, we'll be sharing the available one. The available one, we are going to be sharing it. As we all know, as it is now, the study material is yet to be shared with us by ICAN. So we're expecting ICAN to make provision for the study material. But we cannot just wait because it is not the entire topic that we don't have the available material. We have available material, but we need to update the material based on the changes in syllabus. Based on changes in syllabus. Okay. And this is 5 minutes past 2. So we are starting immediately. So before we move on, somebody should just give us a simple and short opening prayer. Someone, a quick one.
In Jesus' name.
Amen.
In the mighty name of Jesus.
Amen.
Oh Lord,
Amen.
Oh Lord, we commit the beginning of this diet into your hands. We lift up all the courses that we are going to be doing this diet, and we ask you, Lord, that you provide us with wisdom and understanding and retentive memory so that even on the day of exam, we'll be able to put down all that we have learned. We ask that you take charge of this diet. We ask that you also give the lecturers the strength to show up to teach us, and we, the students, the strength to also partake to learn. We ask, oh Lord, that you take control of all that will happen this diet, and at the end of the day, may we come testifying to your goodness. In Jesus' mighty name we have prayed.
Amen. So thank you. So we have announced the diet open.
Amen.
All right. You are welcome. I said before we continue that we are going to tell ourselves the rules and regulation of the game. The rules and regulation of the game. And I can appreciate majority of us that we have started abiding by one out of the rules and regulation. And the number one from the rules and regulation is that as you are joining, please, we need you all to mute your mic. So I appreciate you all for that. I believe at this stage, we are now a strategic manager, not an application manager any longer. That is part of reason why the institute look at some topics that are supposed to be for application. They take them back to application, then move up. Those are supposed to be for strategic managers. They move them back to the final level. So that is one. As you are joining, we need you to do what? Mute your mic. You know the essence of that. In order not to distract the flow of the class. If you have question, rules and regulation number 2, if you have any question, you can easily put up your hand. If you look at your app or the system you are using, so you will see an icon that represents hand. Just put up your hand. We are going to recognize you. You will talk, then you mute back your mic. Number 3. As you are joining, we need you all to participate. As you are joining, we need you all to participate. Under that, do not leave any class unattended. Do not leave any class what? Unattended. I believe that person is just joining. Okay. Are we all together, please?
Yes, sir.
All right. So do not leave any class unattended. Please, you are the final stage. You are different from foundation or ATS level. At this stage, you have done all necessary things for you to move up to this level. What you need now, just try as much as possible to give all you need for you to just pass this exam and become a member so that you and I will now be a colleague. So how are you going to go about that? It's possible that you will not miss any class. You have the timetable already available. Avoid unnecessary party. And some of us may have a very serious meeting to attend to. So because of that, we may take a leave without joining the class. So in that aspect, you have the recorded class. As we are speaking now, this class is a recorded one. So what you are going to do for you not to miss that class is that please try as much as possible to do what? To go and watch the video of the previous class before the next class. To watch what? The video class. If you are unable to join the live, to try as much as possible to watch the video class. Rewatching the video class is not limited to only those that did not visit the class physically or real time. So you as well, that you are always punctual. So you can as well rewatch what we have treated in the class for full understanding. So that is rule number 3. Now, rule number 4. Rule number 4. Please, this is strategic financial management. It's different from advanced audit and assurance and some fully covered theory courses. You need your writing materials. You need your writing material. And your writing material comprises of your notebook, your pen, and your calculator. Your notebook, your pen, and your calculator. Some of us find ourselves in an unorganized situation. As we speak, somebody can be using A4 paper. So it's not time for question yet. I will give you room. So somebody may be using a sheet of paper as we speak now for the lecture notes. By the time the person wants to do revision, we'll be looking around the corner or in the office to see where the person is has jotted their information. You need a note, and don't combine SFM with audit or with tax or with SBR. Have separate note for all courses. If it is possible as well, for courses that we have 2 lecturers, if possible, you can even devise a means to have different notes for each lecturer. Because the first lecturer this morning took you risk management, and he is going to continue from where he stopped. So why me or any other colleague will be taking another topic, and either me or any other person that will be taking it, we do what? We also continue from where he or she stopped, so that you are going to have what? A free flow of the classes. So that is about the note. Your pen, so must be available. And the last one, calculator. Please don't joke with that calculator. We have seen news or information after the exam period whereby some people will say that it's the calculator that fucked them up. The calculator you want to use, you're supposed to have been making use of it from now before the examination. Somebody will be buying calculator 3 days before exam. We have seen people that buy calculator even at the exam venue. You don't know what is the condition of the calculator. Maybe the battery is not in good condition. Maybe the calculator, either plus or the divide is not working properly. But if you are gotten one at the start of this lecture, if there will be any problem, we will have identified such problem on that calculator. So these are the 4 key rules and regulations that I'm having now. Then as the class continue, so any other tips that we need to give you to aid your preparation towards the examination, we'll be sharing it with you all. I have not introduced myself. My name is Yusuf Olatunji. You can as well call me Success. So you are all welcome. So I will get to know you all one by other as the class progress. So thank you. You are all welcome to this diet. Now, before taking this topic, let me quickly go back to the syllabus. It is not news any longer that the syllabus has been reviewed. And based on the revision of the syllabus, there are changes to the courses, the topics, yes, there are changes to the topics that will be taken. On SFM, for some of us that have took our time to study the syllabus very well, you will have discovered what are the changes to the syllabus. I think Mr. Unwen sent the course plan. All right, let me quickly open the course plan. We need that to aid the class and to aid our plan as well. Hold on. Course plan. Are we together, please?
Yes. Yes, sir.
All right.
Yes, I will too.
Okay. So this is the course plan. Please also confirm. Somebody should confirm if you can see my screen.
You can see it, sir.
Yes, sir, we can see it.
All right. All right. So here is the course plan. And I think Mr. Unwem is not fully informed about the division of labor. Although initially it is between Mr. Unwem and I that take strategic financial management. But because of the change in syllabus, we have to redesign the plan. So Mr. Unwem divided this into 2. 50% or half of the syllabus will be taken by Mr. Unwem, while the remaining 50% will be. So you have risk management, advanced investment appraisal, and advanced risk management, which will be handled by Mr. Unwem. These 3 main topics, they are regular topics that we usually have in strategic financial management. Then why on the other part, the one that is quoted to be taken by me, we have introduction to business strategy and financial management. We have strategic management, we have governance, and we have acquisition, mergers, corporate restructuring, and reorganization. So the aspect that Mr. Unwem is not fully aware of is that I will only take 2 portions out of these 4. 1, 2, 3, 4. Out of these 5. Sorry, out of the 4, I will take 2. Then we have Mr. Inyadawasiu, which also be taking 2 portions of this course. So the portion I will be taking will be Domain A, Introduction to Business Strategy and Financial Management. And Domain F, Acquisitions, Mergers, Corporate Restructuring, and Reorganization. While Mr. Inyadawasiu will be taking Domain B and Domain C, Strategic Management and Governance. Strategic Management and Governance. So we divide this because of individual experts. So Mr. Onwem is fully involved in risk management, and that is what he's into in practice. While Mr. Inyandawasiu is into strategic management and governance. So we are giving it to the best lecturer that we know that can handle each domain. So that is what we did. While majority of what I usually take before in the old syllabus in strategic management, strategic financial management, they were all moved, or majority, 80%, if not 90%, were moved back to the skills level under financial management. So that is how the syllabus is being divided. So Mr. Owen will be taking the morning portion, while me and Mr. Inyandawasi will be taking the afternoon section. So you're supposed to have thanked the institute for thinking of this development. Mercy, your question?
Yes, sir. Yes, sir. Can I ask my question, sir?
You can go ahead. Go ahead.
So, sir, you mean all those cost of capital, cost of equity,
gone forever.
Ha! Thank God. Thank God. Hey,
so you're
God.
supposed to
I'm
thank
so
the
happy.
management of the institute for doing you
Voila.
good. It's not voila, it's a joy now. But your rejoice should now be that you are going to take advantage of it, in the sense that the institutes are looking at you to be a strategic manager, taking decisions strategically, not you taking an application any longer. Calculation, you calculate business valuation, investment appraiser, cost of capital, approaches, among others. So they have removed all those stress from you. So this is just what you are going to do. So while we await the syllabus, the study material. So I think the only aspect that we may be waiting for from the study material should just be only this domain A, which is under Introduction to Business Strategy and Financial Management. Every other thing that we have here, individual lecturer that are handling them, they have all the required material to cover everything. So I've answered Mercy. Temi Dio.
Good afternoon, sir.
Good afternoon.
Okay, sir. Concerning those topics that they moved to financial management, like those cost of capital we're discussing,
yes,
is it not expected of us as a strategic manager to know those things? Because for somebody that didn't do financial management in skills, then you passed, you now move to professional. That person will not even go through all those cost of capital, those investment appraisal, and among others that they've moved to financial management. Would that not cause a knowledge gap in the field?
There won't be a knowledge gap, except if you started this profession from foundation level, and this happened this way. That should be the only candidate that may have that knowledge gap. Because as you are, if you are to register being a graduate, you must have attained a minimum requirement, and part of it is that you must be a graduate of accounting, either BSc or HND. So, and for you to be a graduate of BSc or HND in an accredited institution, all those are supposed to be part of what you have applied under your application skills, either your ND or ND1, HND1 or HND2, or at your 300 level in any of the institutions that you have attained. So there won't be any form of knowledge gap. Is that clear?
Yes, sir. Thank you, sir.
You are welcome. In fact, if you look at it, there are some topics that you are at your skills level that will be treated at foundation level. Although you may not be fully satisfied why they took you those topics in your institution. But when you come to accreditation, so the institute believe that you will have gone through those stages instead of you now repeating what you have taught, what you have done before. So that is why they are taking it to each level that you're supposed to have most of those courses. So being a strategic manager now, what you are going to be doing is what? Having your report and take decision. Write a report, make a strategic decision. I will take this last two questions. Adeniyi and Chukwuka. Adeniyi.
Okay, good afternoon.
You are
Please,
welcome.
my own question is with respect to the way they have done this course outline according to domains, and some percentages has been attached to it.
Allocated.
Are we
yes.
saying that these percentages is the percentages on the ICAN syllabus on how it will be tested?
Yes, this is how it is. This is how it is on the syllabus. And
Okay,
it doesn't mean that the examiner will test 15% in risk management, 30% in advanced investment appraisal, the way it is. In fact, at times in the exam, if examiner want to test, they may now test maybe 10% in advanced investment appraisal. But what they are telling us is that these are the percentage that the syllabus are covering, so that you know that you don't need to leave anything untouched. And the one that is least among them, I think, is that introduction to business strategy and financial management. It is possible in this 10% domain, they may not even test any question in it. Or if they will test any question, maybe it will be in B or C part of the requirements. They will just be a supporting questions to the main topics that will be treated.
Okay. Thank you.
So the last person.
Hello, sir.
Yes, Chukwuka.
I was going to ask. ICAN study pack for this new syllabus.
You said?
Do we have new ICAN?
I thought you were supposed to be using the hand raise button. My hand has been raised up, so
I'm making use of. I've mentioned it. If you have questions, you can put up your hand. And I've also stated that I'm going to attend to just these last two. Then if you have any other question, that will be at the end of the class. So the last lady that is talking, that is speaking, is that Adeniyi or Chukwuka? Hello. Okay. So if there is no any other question to pick, please let us move on to the business of the day. So if you have any other question, you can relate those questions after the class. So let's move on to the business of today. Wonders of God. Are you the one asking that question lastly?
I'm the one that is supposed to ask a question. Like I'm Chukwuka Ejiofor.
Okay. Okay. Yeah, Chukwuka. Let me have you and Wonders of God. Chukwuka. Chukwuka.
Okay, sir. I wanted to ask, apart from, yes, sir. Thank you, sir. Can I be heard?
Yes, yes. Move on.
Yeah, before the syllable change, when I was in skills, I had just one paper, which was foundation to write in skills. So I used the opportunity to form some notes under this SFM. And unfortunately, it happens to be the one that had the most change in the syllable. Yes, so most of the note I formed now, I just heard you saying that cost of capital is no longer there. Apart from cost of capital, which other one is no longer relevant here? Sorry for asking.
Okay, Chukwuka, chat me after the class. I will give you the full information.
Oh. Okay, thank you very much, sir.
You are welcome. Then lastly, Wonders of God.
Okay, so I was going to ask, do we have a new ICAN part or with the new syllabus for these courses?
Okay. Firstly, ICAN is here to give us the new study notes They are yet to give us the new study notes. And we believe that before the middle of this diet, the notes will be available. That is one. And secondly, there are the changes that we have, they are just, in SFM, we have major changes. But the major changes that we have in domain B and domain C, domain B and domain B and D, yes, domain B and D. These two domain, they are courses at the skills level. They are courses at, their topics at the skills level, and they now bring it back to professional level. These are courses from CSME at skills level before. Strategic management and governance, there are courses at CSME, but it is now being reintroduced at the final stage under the strategic financial management. So everything you have there, if there will be changes, there will just be slight changes. And looking at it, the subtopics, everything there are all relevant to what we are having in the previous syllabus. That is why we even brought the lecturer that is very versatile in that aspect to come and take it. So that is one. Then every other one that we have there, even if there will be changes, nothing will affect the application and the processes. If they are going to add to it, maybe they will just add current trends to some of what we are having. So we are not disturbed. So we have all it takes for you to pass the examination and for you to also have the knowledge of what you are paying for here. All right. So thank you all. We have used a whole 30 minutes for introduction, and we need that because it's a guide. If it is that we are using the normal syllabus, we don't need all this form of introduction. And the essence of this, again, it may not be new to some of us that we are at the professional level before, and we skipped SFM before, we want to write it now, or somebody wrote it before, maybe because of 2 mark, the examiner denied us to be a graduate of the institute, be a member of the institute. But that is not a problem. They even bring out, they remove, what is it called, trouble from your neck. Instead of you thinking of cost of capital alone, those that can relate will relate. Now, so it is no longer like the way you have too much of stress at the final stage. It is now a lesser stress, to be a lesser stress. So there, that may be the case. You have all it takes to ensure that you pass this examination in just one sitting. So let's move on to the business of the day. Cost plan. Hold on. I'm looking for my slide. Okay. Can we see my screen now?
Not yet, sir.
No, sir. No, sir.
Okay. What about now?
It's up now.
Yes, sir, it's up.
All right. Introduction to business strategy and financial management. If it is before, we are going to have introduction to strategic financial management. So what the entire of strategic financial management has been moved totally to the skills level, but they removed the strategy, but they only give them financial management. So we are looking at the introduction to business strategy and financial management. Under this, we have 4 subtopics to discuss under these aspects. We have 4 subtopics to be discussed. The first one is the role and responsibility of senior financial executive. The role and responsibility of senior finance executive, followed by financial strategy formulation. Due to updates on my material, I'm here to fully conclude on the remaining 2. And the remaining 2, we have the socio-ethical and governance. Socio-ethical and governance. And lastly, we have trading in a multinational environment. Trading in a multinational environment. So if time permits us, let us look at these first 2 that I've made provision for today. The role and responsibility of senior finance executive or senior finance advisor, followed by the financial strategy formulation. Starting with the key roles and responsibilities of senior finance executive or finance advisor. I want somebody to tell us, what do we refer to, who do we refer to as a senior finance executive?
That's the CFO, sir.
CFO. That is CFO. Now, what makes the difference between the CFO and a finance manager?
Strategic decision.
Strategic and tactical.
Strategic decision. Thank you. Thank you. I love that. Now, you are going to be relating most of these things to part of what I mentioned earlier, that this level, they are separating the applications from the strategic managers. So at this skills level, they push all the calculation aspects to the skills level. What are they doing? They are just to be making application to check the arithmetic accuracy, to prepare the statement, to confirm the authenticity of transaction, to reconcile, among others. But that is still the same function, the same job role to the senior finance executive. But what makes the difference is that the executive is just to look at the report, overview of the report, and submit a recommendation or make a decision from that report. So if you pick most of the role of a financial manager with that of senior finance executive, you are not missing out. Please take note of that. You are not what? You are not missing out. Just that between the finance manager and the senior finance executive in an organization, the senior finance executive will be the one that will be representing the whole finance department in the meeting. And if there will be any issue relating to finance, the person that will be called upon will still be the senior finance executive. Go and investigate and find out what could have been the reason for such report or for any irregularities that could have occurred in the finance of an organization. So that is just an insight for you to see what you want to state under these key roles and responsibility of senior finance executive or finance advisor. Let's move on. The senior finance executive is responsible for making decisions which will increase the wealth of the company's shareholder, which will increase the wealth of the company's shareholder. So the finance manager will prepare the financial statements according to the raw data collected from finance officers. After the preparation, This report will be submitted to the Chief Finance Executive, which is the Senior Finance Executive. And what the Senior Finance Executive wants to do is to analyze, to do comparison, and also to make judgment to the owners of the business as well as the shareholders. So we are going to see all the roles as we move on. So the Senior Finance Executive is responsible for making decisions which will increase the wealth of the company's shareholder. The specific areas of responsibility are listed below. And what are the responsibility? Investment selection and capital resource allocation, raising finance and minimizing the cost of capital, distribution and retention from the total profit, that is dividend policy, communication with stakeholders, both internal and external stakeholders. What are they communicating? Financial policies. It carries out the role of financial planning and control, risk management, and lastly, efficient and effective use of resources. However, it is also important that the senior finance executives consider the impact of his or her role on the other stakeholders of the firm. So that senior finance executive is also having role with stakeholders, those that are having those that are having stake in what an organization does, and we have various stakeholders in an organization. So now let us move on to each of these specific areas of responsibilities of the senior finance executives. We are not new to most of what we are going to discuss here, but we are going to see how to make decision as a senior finance executive on this key responsibility that we are going to pick one after the other. And from all this, that is why you are going to be looking at yourself as what? As a strategic manager at this level. The investment selection is what you have done at your application level, or it is what it is now being assumed that you have done that at your application level, although you are still going to do advanced investment appraisal in this level. It is not new. We have been treating advanced investment appraisal right from the old syllabus, but we still retain that at this level. Chi Amaka, you mistakenly put up your hand because we can see that the hand has been lowered.
Oh, okay. So I just wanted to say, some of us here did not go through skills. We just went straight to professional. Okay. So just keeping that.
You don't have problem about that. Don't worry, we are going to guide you, and our guidance will not be a misleading one because the syllabus has told us what and what you need to know. And if you think that you have not done it before, we are going to prove it to you that you know most of these things before. We'll prove it to you. So investment selection and capital resource allocation is what you have done at your application level or from your higher institution. Let me see, another person hand is up. Zainab.
Good afternoon, sir.
Welcome.
I want to say that the recording has stopped. I'm not sure
the recording, I'm
Yes.
already recording.
Oh, okay. All right, sir.
I'm already recording. Somebody else should confirm that if this class is being recorded.
Yes, it's being recorded.
All right.
Yes, it's being recorded.
Okay. Investment selection and capital resource allocation. So we are not all new to investment appraisal. Before let me just highlight these 3 decisions that will be taken by financial manager. These are the 3 major decisions: investing, financing, and dividend policy. The investment decision required to seek for what type of investments will you embark upon that will be worldwide. So there will be a forecast on what type of investments to be carried on, and what application, what method are you going to use in appraising your investments. That is where you have the traditional and the non-traditional discounting factor method. The investment appraisal under the internal rate of return, payback period. Then you have the modified IRR, you have your net present value, among others. So the investment appraiser, the investment selection and capital resources is requiring investors to know the type of investment to be embarked upon and to know which methods to be adopted in appraising their investments, followed by raising finance and minimizing the cost of capital. So once you have seen the type of business you want to embark upon under the investment selection, investment decision, you need funds to carry on that, your project. You need fund, and that is what you needed under the sources of finance. Then under the sources of finance, you cannot only look for financing without attaching the cost of capital. So the cost of capital that we are also talking about, the cost of capital is the cost that you are going to pay on that capital you want to borrow to carry on that your project. It is the cost that you pay on the capital that you borrow to do what? To carry on a project. So how will you be able to minimize the costs? And that one is under where we look at the equity financing, the debt financing, the preference shares financing, among other sources of financing. So which one are you going to borrow, or which source of finance are you going to look out for at a minimal cost? So that is source of financing. Then the third decision by senior finance executive is what is known as distribution and retention, which is under dividend policy. When you look at on investment to be embarked upon under the investment selection, investing decision, and you have seen money to invest on that project, either through equity, owners of the business, from shareholders, or you borrow money from debt capital. So, and source of finance can either be purely equity, or either be purely debt, or be both equity and debt. Just note that the cost of financing equity will be lower or cheaper compared with the cost of financing a business with debt. So now, after you are invested, the purpose of you carrying on a project or investment is to do what? Is to make profits and also allow the shareholders to also enjoy their funds they put into that business. So you now make a decision. You as a strategic manager want to make a decision. And what is that decision? You want to make a decision on that profit. What will be the portion that we are going to keep aside as a reinvestment on the project? And what will be the portion that we are going to pay to the financiers, which is known as what? Dividend. What is the portion, or what will be the policy on the dividend that will be paid out? And what will be the policy on what will be the portion that will now be retained in the business? The next one, we can call it orders. Order responsibility of senior finance executive. These are the major: investment decision, financing decision, and dividend decision. Orders, we have communication with stakeholders. Yes, as a senior finance executive, you have to communicate with stakeholders. Okay, if you are an existing shareholders, the company is having a new share to be announced to existing shareholder, and this will be the benefit from you having additions to your existing shares. Other stakeholders like suppliers. It is also the function of the senior finance executive to carry on communication with all stakeholders. Planning, financial planning and control. Yes, is also the one in charge of what will I put it? Which form will I put it? Treasury. Yes, let me put it in that form. The senior finance executive is still the one that is in charge of what? Treasury. How to manage the available resources. Planning, financial planning and what? And control. Then after that, we have risk management. There's no business that is not having its risks. And all those things are part of what Mr. Unwem is going to analyze to us. He will have started with some of them as we speak this morning. So he's a risk manager. Look at various investments and what are the likely risks that may affect different investments to know what type of risks are we going to hedge, we want to run away from, and what type of risk that we are already available to do what? To accept, because it is not all risks that is what? That is avoidable. It is not all risks that is avoidable. There are risks that are related to individual investment, individual business. And in all businesses has their own peculiarity of risks. You can't do without that. So it is still part of the function of the senior finance executive to carry on a risk management. And lastly, efficient and effective use of resources. I think somebody background sound is disturbing. So please, if you are the one, I will recap
That's
that.
Prof.
So Prof is the one talking. I'm the Prof here. So aside from Prof, that is mic supposed to be on mute. So every other individual should please mute their mic. So these are the key responsibility of the senior finance executives. Now, we need to take them one by other in detail. The first one is investment selection and capital resource allocation. The primary goal of a company should be the maximization of shareholders' wealth. That is the major objective of an organization, except for not-for-profit making organization, that their primary objective will not be what? To maximize shareholders' wealth, but for the purpose in which that organization is being established, in which such non-profit organization is being established. So therefore, the key policy decisions need to be made. And what are the key policy decisions under the investment selection and capital resources allocation? One is how to incorporate ethical issues such as minimizing potential pollution or refusal to trade with unacceptable regimes into the investment appraisal process. So one out of it is that this investment I have to embark upon, is it the investment that will not affect third party? Even if I have carried on my appraisal and I can see that the appraisal is worldwide, and part of what you need to put into consideration is what? Ethical issues. Won't you have an example of which is what? Potential pollution or refusal to trade with unacceptable regimes into the investment appraisal techniques. Adeni.
Sir, please, I want to seek a request from you.
Okay.
Can you this material you are using? Can you share with us now so that we can be the way you are explaining it, so that if it is not clear, we can scroll back and reread it and check it. Then it will help us to assimilate as we are going, sir.
No issue about that. I've mentioned it earlier that I'm going to share it with us, but never been not to deny us of information required. And take note that this note will be updated from time to time, and we'll be giving you the updated one.
No problem, sir.
Wendy.
No problem, sir. No problem, sir. Thank you, sir.
You are welcome. So check your WhatsApp now. I've shared that already. All right. I hope you can still see my screen.
Yes, we can see it.
Okay.
Yes, we can.
So we said one of the policy decision to be taken under investment selection is how to incorporate ethical issues with that investment that you want to appraise in such a way that it will not affect third party. Another question to ask is, what method of investment appraisal should be used? Is it the net present value? Is it the internal rate of return? Is it the payback period? Among other investment appraisal techniques. So that is that under the investing or investment decision. The second decision, raising finance and minimizing the cost of capital. Even if you have the best investment appraisal techniques to be adopted, you have come with an idea, a business strategy, a proposal, the method, the procedure to be followed, the location to invest in, among others. You have done all your visibility study. Without funds, all that your techniques or process that you have taken will not come to reality without funds. And you need what? You need to raise finance. Even if you are the owner of that business and you want to start with your owner's equity, you have to still look for how are you going to invest that your equity, your own capital, the one you have. You don't want to go and borrow. How are you going to finance it? And you make an assumption on that finance that you want to use, even if it is not a debt financing. Originally, what should be the cost if I am to invest in a particular project? Or if I'm to borrow funds up to this value that I want to use as a starting capital on this investment, what is the average interest rate on the investment? Then what will be the average return that I will be expecting from such investments? So a key aspect of financial management is the raising of funds to finance either existing business or new investments. As with investment decisions, the main objective with raising finance is assumed to be the maximization of shareholders' wealth. And for you to do that, you need to minimize the cost of capital. You can have a different debt financing, but you look at what are the associated costs that will be minimal, which at the end will maximize the shareholders' wealth. So the following issue need to be considered when setting criteria for future finance and deciding policy. So you have to ask yourself some questions or put into consideration some of these steps. One, what sources of finance are available? Is it from shareholders? Will it be from family members? Will it be from the owners of the investments? Will it be a debt financing? Even if it is a debt financing, what type of debt financing am I looking onto? Is it possible for me to get a debt from Bank of Industry, which the interest rate is lower to all other conventional financial institutions. So you have to take into consideration what sources of finance are available. Even if you are having equity financing, either through your shareholders or the owner's equity, owner's contribution, will that be sufficient enough for me to start up that investment that I have taken decision in the first stage? If not, then definitely maybe there will be a what? A financing mix, which will be a combination of what? Both equity and debt. So you have to take into consideration what sources of finance that are available. Hold on, please. Let me reshare this screen. The column for me to identify my students disappeared. So that I can recognize if anyone is putting up their hands. So I believe you can see my screen now.
Yes, we can see your screen.
Yes. So let's move on. So what sources of finance are available? You have to put that into consideration. You look at the tax implications on the sources of financing. Do you have a government grant from the source of financing?
No.
If there is government grants, would there be a tax incentives on the type of projects or investment that I want to embark upon? So you have to put that into consideration. If it's a qualifying capital item that you want to invest upon, so you have to consider the tax implication. We move on to the risk profile of investors and management. We have to consider the profile, the risk profile of the investors and management. All investors, they are risk taker. All investors are what? They are all a risk takers. By putting in their funds into your investment, they have took a vital risk. But we have a terminology used in finance department or investment financing, which is known as what? Risk and return. So we look at the relationship between risk and return. So if you cannot take any risks, so definitely you will not expect any return. And that saying is what? The higher the risks, the higher the what? The higher the return on the higher the return on investment. So you have to put into consideration the risk profile of investors, and the risks will be different from one another. The high-rated investors, we have higher risk compared with the low-rated investors, as well as management. Management are also taking their risks. They have their risks as well. If we don't consider any other risks, risks of what? Being active, participating on a day-to-day running of the business is a risk on its own. So that should also be put into consideration. Restrictions such as debt covenants. You look at the policy on raising finance. Would there be any restriction to using any of the assets as what? As a security for sourcing for the financing? And lastly, implications for key ratios. You put into consideration some key ratios, financial ratios. And part of the key ratios, we've talked about sources of finance and what? And cost of financing. So the key ratio, part of the key ratio you have to put into consideration, we have your profitability ratio. What is the margin, profit margin on revenue. And that your profit margin or revenue should not be lesser to what? To cost of financing, cost of sourcing for finance. So you have to have the minimum return, minimum expected return on your investors. The third one, distribution, or let me put it in form of dividend policy. The secret behind dividend policy is on profit. Profit. And that profit is after all essential expenditure have been taken care of, including taxation, which is your net profit. Profit after taxation. And what is that policy that we are now looking at under the profit? What is the portion out of the whole profit that we are to declare as what? As dividend. So if you are declaring any portion of that profit as dividend, automatically the remaining portion will be known as retained earnings. Will be known as, or will be regarded as, retained earnings. So that is that on the dividend policy. So when deciding how much cash to distribute to shareholders, the company directors must keep in mind that the firm's objective is to maximize shareholders' value. The purpose, the company directors must keep in their mind the purpose or the objective of that investment is to do what? Is to maximize shareholders' value. So you must to put into consideration shareholder value that arises from the current value of their share, which in turn is derived from the cash flow from investment decisions taken by the company's management. So if you have existing shareholders and they have the portion of the shares that they made available at the initial stage,
Sir, you are muted.
can you hear me now?
Yes, sir.
Yes, we can hear you now.
All right. Let me go back to the decisions under the distribution or dividend policy. So the company directors must keep in mind that the firm's objective is to do what? Is to maximize shareholders' value. And what are the things that the company now need to put into consideration to maximize shareholders' value? The shareholders' value arises from the current value of the shares, which in turn derive from the cash flows from investment decisions taken by the company management. Now, you put into consideration, first, the maximization of shareholders' value by considering the shareholders at any point in time, and one of which, if the business achieve its first goal at the first point of establishment, what you'll be looking out for is what? Is expansion. And during that expansion, the expansion should not only be for the owners or for you alone. You have to put into consideration the shareholders' value as well. And for you to do that, before thinking of debt financing for expansion purpose, you can have what? The shareholders to do what? To buy additional shares. And by that, the dividend of the shareholders will also keep on what? Increasing. Retained earnings are a significant source of finance for companies, and therefore directors need to ensure that a balance is struck. That is the very easiest way to expand a business is through retained earning. With your retained earnings, you don't need to go and source for too much of capital for expansion purpose. In fact, there are some businesses that make use of what? Their retained earning for expansion. And you will see banks and financial institutions approaching such business due to the growth that they perceive in that business that we have a lot of facility for your business. So some business survive with their retained earning. But if you still think that that expansion you are aiming at will cover more than your retained earning, so you can put into consideration that your shareholders by introducing a new shares. So paying out too much out of your profits may require alternative finance to be found to finance any capital expenditure or working capital requirements. You can see another problem. I mentioned it earlier that the retained profit may be enough for you to do what? To expand. That is one. If that is not enough for you to expand, the first thing you also need to consider is what? Is the shareholders. Then from your dividend policy, you can look out at, instead of declaring too much of dividend to be distribute. So let us bring the dividend a little bit lower and make your retained earning to be higher than what you will have proposed earlier. And paying out too little may fail to give shareholders their required income levels. So you just oppose the two decisions. Your dividend that you are going to be paying out should not be too low. Then the retained profit should not also be too lower to the extent that you may be in need of expansion through debt financing. So the dividend payout policy, therefore, should be based on investor preferences for cash dividends now or capital gains in future from enhanced share value resultant from reinvestments into projects with a positive net present value. So take note of this. That is why I put it in bold. It is the task of the senior finance executive to decide on the appropriate policy for determining distributions and retention. So you as a strategic manager, you are the one to give an advice on the policy to be adopted on the profits. That is, what will be the portion that will be retained and what will be the portion that will be distributed as dividend. Okay. Communications with stakeholders. That's another responsibility of the senior finance executive or advisor. Is communication with stakeholders. We have done stakeholders theory at our skills level or application level. So in that level, you differentiate between the various stakeholders, which is the internal and the external stakeholders. And at this stage, you making a decision, you have to look at the impact of those stakeholders. What are their expectations? And you know, all these stakeholders are differ from one another. Therefore, their expectations will also be what? Will also be different. So communication with stakeholders. A vital role for those running a company is to keep both external and internal stakeholders informed. So they need to be fully informed of all significant matters. If there are any changes that will affect either directly or indirectly, that will affect the stakeholders. So all these must be communicated to all the stakeholders appropriately, considering their different expectations. External stakeholders to be kept informed would include, we have the shareholders, governments, suppliers, customers, community at large, internal stakeholders, corporate goals and financial policies must be communicated to all those involved within the organization. Those are the internal stakeholders, whether at the senior level or in operational positions. And we have the managers or directors as well as employees. So let us refresh our memory. I want to have an interactive section just for 5 minutes. So I will need different individuals just to tell us, to brief, just tell us what are the expectations. You know these stakeholders already. You know them already. But I just need what are the expectations of these different stakeholders. So if you put up your hand, you tell us your name and just pick one out of the stakeholders that you want to refer to. And just tell us what is the expectation of any of the stakeholders that you are selecting. So my question is, state the expectation of any of the following stakeholders. So, Amusa, Suru.
Good afternoon, everybody.
You are welcome.
Okay, yes, I'm taking the shareholders. Their expectation is return on their investment.
Thank you. As simple as that. So, as you have answered my question, you can lower your hand. Olasumbo.
Good afternoon, sir.
You are welcome.
The expectation is compliance to regulatory, especially tax payments.
Okay, very correct. Thank you, Olasumbo. David.
Good afternoon, sir.
You're welcome.
Yes, sir. Concerning employees, salary increment.
And that's the major, but it's not only salary increment that the employees are looking out for. Welfare reason. And what?
Employee benefit.
All those things that they are remuneration.
Growth and development.
Okay, thank you. Thank you. Maybe somebody else will. I'm not still satisfied with that. Hold on.
Business continuity.
I did not recognize you yet. But I appreciate
environment.
Let's mute our mic. I need to recognize you before you answer my question. Olufunke.
Yes, I'll be talking on, my name is Olufunke, like you said. I'll be speaking concerning suppliers. They expect that their financial obligations will be met towards them by the company. So when they supply, they expect that payment will be made to them as at when due.
Thank you very much, Olufunke. Oladokun.
Yeah, good afternoon, everyone. My name is Oladokun Blessings. I'll be speaking on the customers. So customers expect quality products at affordable price.
At affordable price. In fact, on that one, customer can, because of ₦1, leave that your product and go for another product. As it is at that period that they see that this price is ₦1 different from that one, they will not tell you that one that the price is lower by ₦1. Once they make use of that product, or once they consume that product, they will say, I don't even know that this one is even better than that one that they are selling at the higher price. That's customers for you. Okay. Kim Zhang.
Yes, sir. Good evening, sir.
You're welcome.
I'm talking about the community.
Okay.
The community, they expect employment and economic prosperity within the local environment, sir.
Thank you very much. Economic development or the community development. Why? Why? Somebody is bearing why here. Maybe your name is not properly coded.
Yeah, sorry. Can you hear me, sir?
Your name?
My name is Sharon.
Sharon.
Yeah.
All right, Sharon. So before you next time you are joining us, you join with your name so that we don't call you an unrecognized name. We don't recognize you with Y alone. So Sharon, move on.
Okay, employees they expect job security and a
Thank you.
environment for working.
Thank you. Job security and conducive environment. Somebody have said something about the employee initially. So the primary one that employee expect mostly, the job security is the least from the employee. Reason is that we have seen a lot from practical experience. We see employee jumping from one job to the other, jumping from another one to another one. Within 1 year, you can see one employee that will work for almost 8 organizations. What are they looking for? It's not job security. They are looking for pocket security. We are all looking for, let me put it that way, we are all looking for pocket security. Adeni, lastly.
Okay, I want to talk about government. Government. They are interested in both qualitative and quantitative informations in terms of the performance of the business in terms of taxation and every other thing. Then government, on the other side, they are interested in what the company or the organization is contributing to the environment in terms of their CSR and every other thing.
Thank you very much. Mayowa, you lower your hand. I'm correct. Mayowa, are you there?
Yes, I actually wanted to speak on the community at large, in aspect of the company's social responsibility. That is what
okay. Thank you. Thank you. But nobody talked about manager or director. I think Kayode want to help us out there.
Can I talk about the managers and directors?
Is that Kayode?
No, these are Adeni.
Adeni, you have spoken. Adeni, you have spoken. Let's give another person. Daniel. Or Mary.
Managers and director at the tactical level expect that management decisions are being cascaded down to line managers, day-to-day operation managers, and make sure that things are done accordingly.
Okay.
Expect that directors' decisions sent towards them should.
Thank you.
Motivation.
So lastly, Mary.
Okay, sir, they are expecting profit maximization and growth of the business.
Beyond that, or let me put it this way, why will the managers be looking at profit maximization? Being a manager is just an what is it called, appointment position, whereby you'll be paid for that position that you are holding, or a director.
So the manager is interested in the going concern of the company to sustain his story.
All right. So you all have all spoken very well and interesting. So please let us lower our hand and we need to move on. So we need to test this. So exam question can be tested in any form. So and a case may be given on to us and we'll be asked to analyze based on the provided information. So let us move on. So the stakeholders, we've looked at the internal and the external. In addition to information about corporate goals, key matters of financial policy, we also need to be communicated to stakeholders. Stakeholders will need information about dividend policy, expected return on new investment projects, gearing levels, and risk profile. Suppliers and customer, we need information about payment policies. When will the payment be made? If the agreement is that when we're having a trade credit, you supply us raw material for use, then we'll be paying back maybe at the end of each month or quarterly before a new or fresh materials will be supplied. So what the supplier will be expecting as part of their own expectation will be what? On the payment policy. On the payment policy, if it will be favorable to the supplier, while on the customer side, is pricing policy. That is the key aspect of the customers. I stated it earlier. Customers are so sensitive when it comes to pricing. Customer can leave one product to another because of what? Because of price, without considering the quality of that product. In fact, that will be the period. I mentioned that earlier. The customer will now be saying, I've witnessed it before. Oh, I don't even know that this detergent is even better than the other one that I'm buying before. In fact, it's even more cheaper to the one that I'm using. It's a lie. It's not better. What is better is the price to the customer. What is better to that customer is the price. So what the customer will be firstly interested in is just few among customers that will be looking out for quality first. It will be few. If you put it on percentage, maybe 20% that will be looking at the pricing, and that will be looking at the quality, sorry. Why 80% will be going for the pricing. And that is why the market is so competitive in nature. Now, that is that about stakeholder communication to both internal and external stakeholders. So the next role of a senior finance executive is financial planning and control. Financial planning and control. Financial planning and control is the main role of the management accountant within a company. So the senior finance executive will need to oversee the development of policies to govern the way in which the process is carried out. The management accounting process is being carried out. So it is the role of the senior finance executive. It may not be the one to partake in the process, but to ensure that all these processes were being followed. So policies will be needed over areas such as the planning process. And the planning process will include, okay, in the previous period, we embark on a particular project, and at the end of the period, this is the outcome of the project. And in that same period, let us look at the customer's demand. What are the demand compared to the current capacity? Okay, with that capacity, what do we need? Okay, we have to expand our production line. And for us to be able to do that, what is our working capital in the previous period? And the working capital when you are expanding will not be the same as when you are at the initial stage. So these are the roles of the senior finance executive. Business plans. MI, Mercy.
Yeah, sir, please, I want to confirm. Can you check whether this thing is recording? Because my system is not showing that it's recording, or maybe it's from my side.
We are recorded. We are covered. Somebody else should also confirm, because this is the second person that is asking if this is being recorded.
It's recording.
It's recording.
So, Mercy, you are covered.
Okay, sir. Thank you, sir.
So, the business plans. Okay, do we have a new project to be embarked upon? What is the plan that will be put in place? Budget setting. On the budget setting, okay, based on expansion and based on increase in demand, let us look at our previous year's budgets and let us base our budgeting on what? On previous records, and to see what will be the plan for the current operation. Monitoring and correcting activities is also part of the role of the senior financial executive, is to monitor activities in order to have the attained goal. And lastly, evaluating performance. Okay, this is the set objective. Then do we achieve using what? Using a scorecard. Using a scorecard to evaluate performance. The next one from the role after financial planning and control as one of the role of senior finance executive, we have the management of risks. Management of risks. All businesses with their different risks. Aside from the risks that will affect all business generally, which you cannot do without. So it is still part of the role of the senior finance executive to look at ways to manage risks or the occurrence of a risk. So one of the key matters to consider when developing a financial policy framework is the way risks and risk management is to be incorporated into the decision-making process. A number of policy decisions must be made. And what are the policy decisions? What is the firm's appetite for risks? What is the risk that the company can accept? What is the appetite? Okay, if we have varieties of risks, among the variety, how many risks can the company or can the business or can the project or investment will be able to entertain? So what is the firm's appetite for risks? How should risks be monitored as part of the role being managing the risks of a business? And how should risk be dealt with? How do we attend to risks? Even when we face it, how do we manage such risks, including those that we think that we will be able to do what? To minimize. If it is out of control, to either opt out on that risk totally or to reduce the risk. But how do we minimize, how do we arrest such risks in order not to have adverse effects on the business? And the last role is use of resources. Is use of resources. And under that use of resources, that one is just talking about the management of resources. All resources are scarce in nature. All resources are scarce in nature. And whatever resources that we are referring to, the major one will be the financial resources. The other resources, you are still going to make use of what? Finance to cater for all. And the use of these resources, it will be important to develop a framework to ensure all resources, the inventory, labor, and non-current assets, as well as cash, are to provide value for money. That is, there must be a value for all the resources available, managing the resources. So spending must be economic, efficient, and effective. Economy, efficient, and effective. Mayowa.
Thank you, sir. So my question is, we have some organization whereby under finance department, you still have head of account, head of treasury, finance manager. So my question now is the chief senior finance executive, is it still saddled with all this responsibility that we've listed, that you just explained now? Is it still the function of the chief senior financial executive? Or this function at, they are disseminated into, treasury will pick the word that relates to treasury, or is still the responsibility of the senior financial executive?
All right. One, to the answer is that depending on how an organization is being structured, that is one. depending on what? How an organization is being structured. Then the second one, all that role, they fall under the senior finance executive. Senior finance executive. Some company we call them finance directors. Finance director. Some company we call them CFO. CFO. They are those that work directly with the directors, the owners of the business. They are making decisions on behalf of the business, on behalf of the owners of the business. So all finance role fall under the senior finance executives. Mayowa?
I'm with you, sir.
Is that clear?
Yes, sir.
And this role, it doesn't depend on the qualification of the person involved. It doesn't depend on the qualification of the person involved. Sometimes it may depend on the experience and loyalty. Experience and loyalty of such individual. So if you look at most of organization, they prefer making use of somebody that has stayed in the organization and know most of the responsibility or know most of on the job than any other individual that will come in newly. Why some we employ an experienced person that will be acting on that function or role. Now I'm having an assignment for us. Hey, apology about this. I will try as much as possible to go and make use of my own learning management system, LMS, whereby quiz like this or questions like this, I'm going to send it to the platform where you will all pick your own from that platform, and the date and the deadline for you to submit will be stated on it. And where you are going to submit such assignment, you will also be communicated for me to have easy access to all submission. So this is part of what we do here. Every time we have a class, we want you to also practicalize what have been said or what we have treated in the class related to the topic that we have treated, and also relating to what you'll be expecting in the exam context. So I'm having one do it yourself for the topic we just concluded now. It is a common misconception that profit maximization is the key objective of most publicly owned companies. Give reason why this objective will be insufficient for investors. This is the first assignment I'm giving to us in the course of this class. And I will need every one of us. It's possible for all of us to submit. But if I have majority submission, I would prefer the majority to take the lead. So, and this should be submitted on or before close of business on Wednesday. On or before close of business on Wednesday. So it's a common misconception that profit maximization is the key objective of most publicly owned companies. Give reasons why this objective would be insufficient for investors. Before we move on to the next subtopic under the introduction to business, what's the headings? I'm not used to this for now. Introduction to business strategy and financial management. So before we move on to the subtopic, the next subtopic, any question?
Please, could you come again with the assignment topic?
Can you see the assignment now?
Yes, sir. Thank you.
You are welcome. I'm screenshotting it again. and send to the group for you all to see. Although it's even still inside the notes I shared with you. You will see it there. All right. Financial strategy formulation. It's another subtopic. Financial strategy formulation. Under this, I think I will need my writing pad at this stage. Assessing corporate performance. Assessing corporate performance. So there is no topic that is not relevant or any subtopic that is not relevant, because examiner can test your understanding in any form. So corporate performance can be measured using financial ratio and financial trends. This one again, we are not new to it. So let me look out for my writing pad. So we are going to take notes of some, what is it called? Formulas. The formula to financial ratio or trends will not be given to you. And thank God, part of my joy in this type of scenario is that you are doing this financial ratio or financial trend in any of the courses that you are doing at this stage. Even after you have treated it at your skills level, you are still doing some of in one or two of this topic. Olayinka Adeosun. Olayinka.
Sorry, it was a mistake.
Okay. On it. All right. So if you are not doing financial ratio in corporate reporting, which is now strategic business reporting, SBR, thank God you have passed SBR. And for those that are just writing the final stage, you are going to still meet with what? Financial ratio. Even you have done it at your skills level in your financial reporting. You also did it in your performance management. Yes. In fact, you also still do it in your strategic financial management. Public sector accounting and finance. You have done these financial ratios there. Let us leave that. But at this stage, it's either you do it under strategic business reporting, SBR, or you do it in your case study. You can't escape it in your case study. You analyze your financial data, and part of the tools that you use in analyzing your financial data is your financial ratio, which you are going to also give interpretation to them. But here, the application may not be required. If it is going to be required, what you needed is the interpretation. So you need the understanding to know why do we make use of some of this ratio. So at this stage, the formula is not what the examiner is needing from you. Is the application right? Then your interpretation. You will get your mark for your application, then you get mark for the interpretation. All right. Corporate performance is an important foundation for the formulation of financial strategy. So knowledge of company performance will help management to determine new strategies or amend existing strategies to take account of changing circumstances. That's what we use a performance appraiser for. The essence of performance appraiser is to compare the previous records with the current records. And the difference between these two, which is the variance, will now give you an insight if there is a better performance or a worse performance. And for you to now make a decision, what approach or what method are you going to put in place for you to be better off what you are having currently? That is the essence of performance evaluation. So ratio, we said both ratio and trend analysis will be used in evaluating your performance. Ratio is used in assessing the performance of an organization using different variables. And the main ratios are listed below. We have profitability ratio, liquidity ratios, shareholders investment ratio, or stock market ratio, and lastly, debt and gearing ratio. So these are the ratios that was mentioned in the syllabus. I did not come with any practical questions here, but I would like us to just do a hand sketching or in form of going back to the foundation level. And going back to the skills level. So itemize the types of ratios that we have under this subtopic here. Are we ready? I hope you are all with your writing materials. So I'm connecting my writing pad right away so that we can display on the screen. Are we all there?
Yes, sir.
Okay, so let me display I want to display my screen. So we want to test our ability. In fact, even it has been a while that I also lay my hand on some of these analysis, although I make use of majority of this in my monthly reports. A majority of us are also doing same. So I know you. I think I know 3 here. Olasunbo, yes, you are doing that. Mary is also doing that. I think Amusa, you are also doing that. 90 or approximately 100% of those that are here are doing this in practice. Let's go there. Profitability ratio. So who is reminding us what we are doing on profitability ratio?
Net profit ratio, gross profit ratio.
What is that profitability ratio on its own self? It's the assessment on what? On return,
Profits.
which is profits, on return on investment. So what are the types of ratios that we have there?
Profit ratio, gross profit ratio.
Profit ratio is a profit ratio, but what type of profit ratio are you referring to?
Gross profit ratio.
That's what I needed from you. So let me put the headings. Evaluation of performance or performance evaluation. So the first one, we said we have profitability ratio. So under that, so somebody said that we have what type of ratio?
Gross profit
Gross
ratio,
profit margin.
Gross profit margin. Okay.
ROCE.
ROCE, return on what? Capital employed.
Capital.
Next.
Net profit margin.
Net profit margin. Next. Any other one?
Expenses ratio.
Profit margin.
Operating profit.
Expenses ratio. expenses margin. Ratio or margins.
Operating profit margin.
Operating profit margin.
Are you there?
We have the earning per share.
It's still not complete, so I know we have more than this. So
operating profit margin. Operating profit.
Return on assets.
See, that's part of what I'm requesting for. See, if you tell me profit margin, I believe that profit margin can cover gross profit, net profit, operating profit, any other profit margin. So somebody said return on what?
Return on assets.
Okay, thank you.
On asset turnover.
We also have return on equity.
Return on equity.
Earning per share ratio.
Earning per share ratio will be under another class.
That's not under profitable ratios.
Yes, it will be under another class. So let us just identify all these ratios first. The A part. So somebody said return on assets, right? Return on assets.
Yes.
Or you call it asset turnover.
Asset turnover.
Thank you. So now let us pick it one by one. Gross profit margin. This will be what?
Gross
That
profit
is your
over
GP
sales.
Gross profit
over
to
what?
sales.
Over sales multiplied by 100, right? The second one, you said return on what? Capital employed. ROCE. ROCE will be what? Hello, somebody.
Profit before interest and tax.
You went to go and look at your book. I get you. Divided by what?
No. Divided by capital employed.
Somebody should now define what capital employees. Somebody should define what capital employees.
Capital employed can be your total assets, depending on what you want to use. It can be your
definition,
assets.
yes.
Equity
your definition will give you what you are going to make use of. So, who is giving me the first explanation on capital employed? Who is defining our capital employed first?
Total asset minus current liabilities.
Total assets less current liability. Total assets less current liability. Or
Equity plus debt.
Equity plus debt. Non-current
what type
liability.
of debt are we now referring to? It's not the entirety of the debt. The equity plus debt is the equity plus debt is what you refer to as total asset less your current liability here. So if you are saying equity plus debt, what portion of debt are you now referring to?
It's long-term debt.
Long-term debt, yes. Equity plus what? Long-term debt. Long-term debt. That is ROCE. The next one, we have net profit margin. Don't let me stress myself on this other two. Net profit margin or return on what is it called? Or operating profit margin is still the same thing. NPM is what? Is your net profit divided by what? Divided by
Sales.
revenue. Thank you. divided by revenue or sales times what? Times 100 over 1. So don't let me waste my material or resources on that one. So we have return on equity. You said? NPM, net profit margin.
TDIT, not NPM.
So the next one, return on equity and asset turnover. Return on equity.
So please, can you give 5 seconds to the previous slide?
Okay, no problem. Somebody is having network challenge. That person is trying to talk, but the network is not allowing that person to talk. I think it's Abdul Musa. So can we move on? Are we together?
Yes, sir.
All right.
Yes.
So return on equity.
Profit before interest and tax over equity.
Equity.
Before interest and tax divided by equity. Divided by equity. Then lastly, an asset turnover. Assets turnover.
Hello. Hello, Prof. Hello.
Afis.
Net asset over sales.
Afis, you having question? Okay. So what do we call asset turnover?
Net asset over sales.
Asset turnover. It is on revenue. Asset turnover. Net assets over sales.
All over turnover or sales.
I disagree. I disagree with this.
Sales all over net assets.
Asset turnover. It is on sales. So it will be sales over net assets.
Revenue assets. Sorry,
yes.
Sir.
Yes. It's sales over net assets. We want to know what is the portion of our sales. What is our total sales over the assets for us to know the usage. How have we make use of our assets? And that's for us to be able to measure that. We are going to make use of what? Of our revenue to measure how we have utilized. It is on asset utilization, yes. That is based on what? Asset utilization. And that can be measured through what? Through your sales. So it will be your sales over net assets. Sales over net assets. I believe others are following.
Yes, sir. Yes, sir.
Yes, sir. Yes, sir.
So we need all this in case nobody can say sales over net assets. And we are not even interpreting it. Decision is the key one. Let us take it by one by order again. Gross profit margin. If you are to give your interpretation based on gross profit margin, what will be your decision? What type of decision are you going to make based on gross profit margin? So below bar. So what decision are you giving us on gross profit margin? The same thing is applicable to the net profit margin.
Sorry, sir. I raised my hand for a question.
Okay, and you now met another question. So give us your own question first.
My question,
You've
I was
already been
struggling to
answered.
understand the asset turnover and why we are using net assets as against total assets. I'm not sure I get that.
Okay. As against total assets. Why are we making use of net assets as against total assets? Total assets comprise of the whole assets. But your net assets is an element of your assets less your accumulated depreciation and less your current liability. Your liability is also as a result of what? As a result of you getting your capital. Let me put it in that form. Okay, your debts. Your debts are basically on what? Most of your debt, aside from your working capital debt, which is sometimes it can be in form of trade credit, it can be in form of, can also be in form of overdraft, BOD. Can also be in form of overdraft. Tell me, in all business financing, the debt financing, what portion of the business is your debt financing covering?
Acquisition of assets.
Yes, an acquisition of an asset. If it is not for building, it will be for one equipment or the other that will be used in what? In catering for the business. And your net asset, you know, you are making use of those assets and the debt that you use those assets for, you are also doing what? You are also making your repayments. So if you are making use of just the net assets and not considering your liability, so you will not be able to get the exact turnover on your revenue. And your revenue is not only portion of your machinery alone. Your revenue is not only portion of machinery alone. It's a portion of the entire net asset of the business. Tobiloba.
Thank you, it's clear.
You're welcome. All right. So somebody is trying to give us the interpretation to gross profit and net profit margin. And we have a fees.
Hello?
Yes, we can hear you.
Yeah, please, I need you to clarify where we are using profit after profit before interest and tax for return on equity. Because I think it should be profit after tax because this one is a return that is due to the equity holder, not including the debt holder. So I think it should be profit after tax, payment of tax and interest. Divided by equity.
Return on equity, right?
Yes.
Okay. And in short, that should be earnings attributable to ordinary shareholders.
Shareholders, yes.
Earnings attributable to ordinary shareholders. I hope others are following. Thank you, Afis.
Sir, are we changing the return on capital to earnings attributable to ordinary shareholders? Is that what you just said?
Is the return on equity.
Sir, you are muted. Oh.
Can you hear me now?
Okay, you are back.
All right. So, Amusa, so interpretation. What is the essence of gross profit margin or net profit margin?
Okay, the gross profit margin interpretation is the ability of the company to be able to convert its sales to profit after taking care of the direct costs and other related or indirect expenses. So the higher the gross profit, the better for the organization to be able to cover its
their liability.
Yes, exactly. Thank you, sir.
You are welcome. Adeni, return on capital employed.
Okay, return on capital employed is to the interpretation of it is we are looking at the profit that we made using the contribution of every kobo we invest in the business. What return did they bring before we consider tax component on it? For example, if we use if we have invested like let's say 1 million naira, and at the end of the day we have a profit of let's say 200,000. So if you divide 200,000 by the capital we have employed, it will give us the margin of each unit of the capital we have invested.
That's application. So decision now.
The decision on it is that the
don't forget you are evaluating, and your evaluation will be what? A comparison basis. The higher what? Go ahead.
Okay, the higher returns, the better for the investors. It will give them the confidence that.
Okay. Go ahead.
It give the investors confidence that their resources are used judiciously, and it brings a better returns.
Okay, or in another form, that is for the investors to know how capital intensive is that investment, how capital intensive the business, based on what? Increase in return on capital employed. That is that. Esther.
Okay, thank you very much, sir.
Yours is on what? Your own interpretation will be on what?
It's not interpretation, sir. I have a question.
Okay.
When you gave the formula for return on equity, you said earnings attributed to ordinary shareholders. I wanted to ask if it was the same thing with earnings per share.
No. Earnings it will be in form of value, not per share. Total earnings. Did you get that, Esther?
Yes, sir.
That is total earnings attributable to ordinary shareholders, not earnings per share. So now, Esther, so interpret return on equity. What do you understand by return on equity? Then if you are to make comparison, you want to carry out performance evaluation on either two financial statements or in the same financial statements, two comparative year or two comparative months. So what will be your decision on the two ratio regarding return on equity or asset turnover? Esther?
Okay, so the return on equity is like trying to check what the business has been able to achieve on the investment of the shareholders in the business.
Okay, so is there now difference between the interpretation on return on equity and return on capital employed? Because based on your interpretation now, I'm linking knowledge to return on capital employed. Any other person?
The difference.
Okay.
One is checking profit, while the other one is checking equity contribution.
Thank you. But the interpretation is the same. The interpretation is what? Is the same. So one is on equity, while the other one is on what? Is on capital. Thank you. Asset turnover. Any other one?
I didn't get that differences.
One is on equity, while the other one is on capital. So the equity own is for the shareholders to know the value that they have contributed in terms of their own earnings to the growth of the business. If the return on equity increase between previous period to the current, between the previous period and the current period. Are they needed?
So that was
Okay, on asset turnover.
Please, can we just hold on?
Interpretation of it is that how many times we make use of the resources that we have. The higher the value, the better for the organization and the shareholders. So which means they use the resources they have judiciously. For
efficiently.
Example,
thank you.
Yeah.
It measures how efficiently an asset what have been used. It is measuring the efficiency of an asset. That is asset turnover. That's asset turnover. Okay, what's the next one on the class of ratio that we recognized earlier? Let me go back to the slide.
The next one is,
I think I give
is liquidity ratio, sir.
Okay, liquidity. Don't worry, I will update my.
The raised up.
Enough. I'm not seeing any hand here. Okay, Leonard, your hand is up now. Mayowa, your hand is also up now. Leonard.
So I was trying to find out if it's a safe one to say that return on capital employed is used by the management, why return on equity is for the investors, that's the shareholders. Is it safe to say so?
Yes.
Okay.
You're welcome. Mayowa.
So mine is under liquidity ratio. At least we have current ratios.
You have what?
Current
okay.
ratio.
Okay. So you are itemizing for us under liquidity. We have current ratio.
Then we have acid test ratio.
Acid test. Okay.
Receivable turnover, payable turnover.
Receivable
Sorry, I have a
turnover.
question. This asset turnover, is it not part of efficiency ratio?
Okay. Some will put it as efficiency, while some will bring it to profitability. And if you look at it, I mentioned it, is measuring what? How efficient is the utilization of what? Of the assets. So we can term it under the profitability, then we can still make use it under the efficiency. And the reason why we can, it is more recognized under the profitability is because of your revenue. It's attached to revenue. This is the major reason why you can also recognize it under the profitability. But at this stage, Chiamaka, examiner will not ask you to be giving us where this one belongs. In fact, you may not even give them the classes of ratio. If you are just to have required to analyze the only thing they will ask you, analyze any ratio of your choice and make comments and or advise appropriately as the senior finance executive. I hope that is clear. But we are just using this class just to refresh our memory. In fact, at your application stage, the way examiner usually tests this kind of question is that they are going to tell you that just to analyze minimum of 6 or 8 financial ratio. They may not even ask you to classify them. So you can recognize it either on efficiency ratio or you recognize it under the profitability ratio. So somebody said receivable turnover period, right?
Yes, sir. Yes, sir.
It's still the same thing
Cash
as
ratio.
receivable collection period.
Is receivable not efficiency ratio?
It's a receivable.
You said what?
Receivable is
not
efficiency ratio.
Let us go back to the
It must be
classes
under
again.
liquidity.
Payables and receivables are under efficiency ratios.
Well, let me see the classes I gave to us first. What are the classes I gave to us? That's another thing. What are the classes I itemize?
Profitability,
Profitability, shareholder,
shareholders.
debt.
So since I did not class efficiency. You can see another thing now. My classes ignore efficiency. Are you there? Please mute your mic if you are not contributing. Are you there with me? Hello.
Yes, sir. So I think the
All
third
right.
one should now be cash ratio.
Okay.
It's cash ratio.
The first person mentioned the asset turnover. That's okay. Return, is it return on equity or asset turnover? Asset turnover. Now, why can't we recognize it under efficiency? Fine, efficiency is among the ratio. While from that efficiency, mostly, if you look at your efficiency ratio, some can go for profitability, while some can also go for liquidity. And if you are talking about efficiency, how efficient, liquidity even carry major of your efficiency ratio. Liquidity carry much of your efficiency ratio. But if you can still redesign your classes, efficiency ratio, you can have your asset turnover, your receiving periods, and what's payable payment period. So these three classes can be recognized under the efficiency ratio. So whereas you can recognize that the asset turnover under your profitability, then both receivables and payable can also be recognized under your liquidity ratio. Is that taken? Chiamaka.
Also, okay, so I was going to say the next one is cash ratio.
Okay. All right. Then, dear strategic managers, we are no longer in application. In fact, what I'm sketching is just under probability that maybe examiner will just ask you to, from a particular question in whole, after asking you the major question, they can just ask you maybe in B part, analyze this ratio and give a comment or give a decision why one will be better than the other. So you may not be required to state the classes of ratio and stating the types, and you can pick randomly the types of ratios that you want to analyze. It is only in application that they will make it mandatory for you that you must recognize according to classes. In fact, at application level or skills level self, there are some questions that will not even ask you to classify. Rather, they will just ask you to pick minimum of 8 or 10 ratios, and they will ask you to analyze them. Some will even give you the classes and the types that you are going to analyze. So don't let us stress ourselves too much on the classes. But once we are able to recognize the types, I am okay with that. What I needed from us here is your decision. Do you understand the brain box behind each of these ratios, and how will you give an interpretation to them? Is that clear?
Very well, sir.
All right. So let's move on. I'm not supposed to take my time on this. You can see I did not even put it in the slide, but my mind just told me that let us just look at it. It's still part of the syllabus. It mentioned the ratios that we can use in analyzing our performance. So payable. Somebody mentioned cash. Hello. Chiamaka.
Yes, sir.
So what do you call the next one?
Okay, cash ratio.
Cash ratio. Payable payments period. Then E. Another word for cash ratio. So let's pick it one by one. So current ratio, that one is very straightforward. We are used to that. That is your what?
Current assets minus current liabilities.
You give me a new one. No, I will not take that.
Divided by
current assets all over current liability.
Yes, that is what you ought to say before. Is that not? Current assets divided by what?
Sorry.
I know.
Divided.
By?
So we also have inventory days.
Inventory receivable period, right? Inventory days.
Inventory days.
Current liabilities. This one is not multiplied by any 100 though. What is this one measuring?
Ratio 1.
Ratio.
It's ratio 1.
Yes. Then the next one, acid test.
Current assets.
Current
Minus
assets
what?
minus inventory divided by current liabilities.
Minus inventory.
Current asset divided by current liability.
That's wrong. The lady is right.
Once you know your current ratio, you will remember acid test ratio. The difference is just the inventory that you are going to liability. So this one is also what? Ratio what? Ratio 1. Ratio 1. Receivable turnover period.
A ratio.
Net credit sales divided by average trade receivables.
Somebody, you also carry it upside down, just like the way somebody carry over asset turnover upside down.
Yeah, it's
look at
trade
it.
receivable
Turnover period. Receivable turnover period. So receivables, we have trade receivables.
Receivable all over.
Credit sales.
Average
receivable
all over
over
what?
average credit sales. Average credit sales.
Revenue all over revenue. Divided times
No. Payable is the one that is related to revenue. All over credit sales. See, please ignore the word average, either average trade receivable or average credit sales. Once you know that it is divided by credit sales, the situation whereby you make use of average is when you're having more than one. It is when you're having what? More than one.
Comparative.
I hope you are following. Then multiply by what?
100.
365.
365 days.
365.
365 days.
365 days. Then payable payment period. Is opposite. It is more than opposite.
Trade payable all over cost of sales.
Trade payables. What do you say?
Purchase. All over cost of sales or purchase.
Or so simply put, purchase. Multiply by what?
365.
Your days can be reinterpreted. The examiner may ask you to assume your numbers of days is what? 422. if there is option for that. But if there is no option, so your numbers of days should remain 365 days. Cash ratio. Chiamaka.
Chiamaka will suggest and she will answer us.
Why are you also following my suggestion?
Right, that should be current asset over cash and cash equivalents.
Current assets. Thank you. That guy wants to run away from the answer. That's why he's also selecting Chiamaka that suggested the ratio. Divided by cash and cash equivalents. And lastly, somebody mentioned another thing here, aside from cash ratio.
Hello, sir. I think it's cash and cash equivalent all over current liability.
Yes.
Okay, this one is also upside down.
Yes. And it is current liabilities.
Or credit purchases.
Divided by credit purchase.
365 days.
Multiply by 365 days. And lastly, inventory what? Inventory days.
Sorry, sir, I didn't get this cash ratio. Is it cash and cash?
Cash and cash equivalents.
And you wrote a liquidity ratio instead of ratio.
I wrote what?
Liquidity heading. You wrote ratio instead of ratio.
Liquidity ratio. This money. Okay, so inventory days.
Inventory days is inventory all over cost of sales.
Inventory all over cost of sales. Multiply by what?
Multiply by number of days given, or 365.
Multiply by 365 days. So interpretation, we don't need to waste much of our time here. Current ratio. I think we have to also include the definition of each of these ratios to aid our study. Okay, don't worry. Assignments, do it yourself. Define each of the following ratio and states. I'm going to draft it to define each of the following ratio. Define each of the following ratio and states decision to be taken by management, and define each of the following ratio and states the decision that could be taken by the management. So after you have written that question, so you are going to state all the ratio according to the profitability, state according to liquidity, state according to the other two, shareholders investment ratio, and according to gearing ratio, so that we will not waste too much of our time, but we need to also discuss it here. So current ratio, who is giving us?
Sorry, sir, please. What are the ratios you say we should do? Sorry.
The ratio to do is all the types of ratio that we are writing on this board now. The first 5 we wrote under profitability, A, B, C, D, and E. Under liquidity, we wrote A, B, C, D, E, F. Then when we go to shareholders investment ratio, the numbers of ratio we state there, and the last one under the gearing ratio, the numbers of ratio we also state there. Those are the ratio that we are going to define, and you give us decision on them all. Can you hear me? Amusa, yeah, current ratio. So your decision for current ratio and asset test ratio will be the same. The only difference is that inventory that will make the difference.
Yes. So the current ratio is the ability of the company to be able to use all its current assets to settle all its liability, which if the current asset must be higher than the current liability, then the asset test therefore means that removing the inventory to get the inventory sold on time would delay the payment to settle the liability. So that is why they remove the inventory out of everything. So it has to be one against one, so that when you settle, you will not have any liability against you further.
Thank you, Amusa. Thank you. Anybody on receivable turnover period? It's just from the name, receivable turnover period.
Receivable turnover period also test to ascertain the number of days it takes for the supply of goods to be paid within the period.
To ascertain the minimum period when an organization will pay back their suppliers. That is receivable turnover period. Adaeze, you wanted to say something on payable payment period? I can see your hand up.
So I think it's when
Sorry, did you say from suppliers
from their creditors?
From their creditors, yes. Yes, from their creditors. That is for receivables period. Yes, you are correct. Then the payables payment period is now the one that is relating to the suppliers. It's just the one and opposite. It's vice versa. So cash ratio.
Okay, for cash ratio, it measures the company's ability to pay short-term liabilities using only cash.
Using only what?
Can anybody hear me?
I can't hear you.
I said, can you hear me? I said it measures the company's ability to pay short-term liabilities using only cash.
Thank you. To pay short-term liability. And mostly the short-term liability are mostly in form of what working capital, which can be sourced through a bank overdraft. And some can also be from trade payables, where you purchase some items and
also,
you are going to pay back
also
from
likened to working capital.
Yes.
So it's still as working capital ratio.
Yes. It's also the same thing as your working capital ratio. So, and lastly, we have inventory days. Chiamaka, your hand is up. Inventory days. Amusa, you can go ahead.
The inventory days measures the number of days it takes the company to convert its inventory to receivables. The quicker, the better for the company to have a buoyant cash flow.
Accurately correct. To convert their inventory into what?
Receivables.
Thank you. So the quicker the turnover period, the better for the business in terms of inventory days. All right. So let's move on to the third one under the category, under the class that I gave to us. I think I'm having a shareholders investments ratio, or you can call it stock market ratio. You can also call it stock market ratio. So under the stock market ratio, what do we have there?
Earnings per share.
EPS.
Earnings per share.
Okay.
DPS, dividend per share.
Dividends per share.
DPS. Dividend per share.
Dividends yield.
Okay. Dividend yield.
Dividend yield.
Dividend
So
yield.
this stock market
any
ratio is the same as
ratio.
shareholders investment.
Next.
Dividends payout ratio. Dividends
Dividend
payout ratio.
payout ratio.
Earnings ratio, I be price ratio.
Earnings yield.
That one is price earning ratio. Yes. Is it that we are Googling this thing, or the application is still fresh in our memory? Price earning ratio. Which other one? That's all.
MPS, market price per share.
MPS, market price per share. But that is not a ratio. Market price per share is just a rate. That one is a rate. It's not a ratio. So thank you. So EPS, that is what? Dividend derived by
Total earnings.
what?
Total earnings. No, earnings per share is total earnings.
My mind is on the DPS. So total earnings. Earnings divided by what?
Number of ordinary share.
Numbers of ordinary share. But don't go too deep. If examiner want to test anything like this, don't go too deep by saying that earnings minus preference dividend divided by numbers of ordinary share. Just go. All right, DPS.
Dividend per share.
Total dividends divided by number of ordinary shares.
Dividends divided by numbers of ordinary share. Dividend yield.
Dividends per share divided by market price per share times
EPS
100
divided by MPS
times 100
times 100. Dividend payout ratio.
Dividends per share divided by earnings per share times 100.
EPS over EPS. PE ratio.
One is
PE ratio. We can
market
hear you. We
price
can hear you.
per share divided by earnings per share.
MPS divided by EPS. It's as straightforward as this. It's like we have something cover ratio too under the stock market. Something cover ratio.
Interest cover is the other one.
Cover.
For
Dividend
debt, for
cover.
debt. Interest cover is for debt.
Okay, it's under debt, right? Interest cover ratio is, yes, it's under the gearing ratio. Thank you. It's under gearing ratio. Thank you for that.
But there's also
Interest cover is
dividend.
under. Then we also have dividend cover then. Yes, we have dividend cover. Do we have an EPS over DPS here? EPS over NPS, DPS over EPS.
That's the dividend cover, sir.
Payout ratio. It's still remaining one. That one is EPS over DPS. Do we have any EPS over DPS here?
No, one will have DPS over EPS.
Dividend cover.
That is dividend cover, yes. I remember, even if it has long that I've written application. Dividend cover. EPS over what?
DPS.
Over DPS. So you have decision makers. Yes, MI. Messi.
Please, I have a question. My question is, are we supposed to know all the formulas of this ratio that we are writing?
Not all.
Or just the application?
Not all. Minimum. In fact, minimum of 2 in each is okay. Because, let me give you insights. Minimum of 2 is okay in all. Look at everything that you are talking about. One will lead to the other. The explanation of one will must surely lead to another, because they are related. So something is making them to become what? To become family. So most of them will be related. And if you look at this stock market ratio, all of them, they are related to market index. They will all be related to market index. Profitability, they are all apportioned to profits. So the margin will increase according to how the profit is also increased. And before your profit can increase, you will have minimized the cost. Those are the indications. That's another thing. You look at the indications. What make most of these things to be what? To be higher. That's part of things that I also forgot to tell us. Look at the indications. What are the indications that make some of these differences? I hope we are following. Messi.
Yes, sir. Yes, sir.
All right. Amusa, you have been participating.
Okay, the EPS measures the earnings each shareholder will get. As a result, the higher the EPS, yes, that's how much a share each shareholder will earn. And the higher that EPS, it therefore shows that the company is earns more profit for that period.
Exactly. To pay more profits. So the more, or let me put it this way, the more the company are able to sustain their profitability, even if they are not improving better than their profit, but if they are able to sustain what they are having previously, so it will be better for them to sustain what they have previously than to decline, because the better the profitability, profitability, the better, the more the return that the shareholders will have on their earnings.
On the basis of when it's being declared.
You said?
I said that should be on the basis of when it's declared, or on a yearly basis.
Or on the basis of the daily
dividends being declared.
Yes. It will be at the point where dividend is, and the dividend declaration the dividend has been declared even from the beginning of the investment. Just that it will not be declared, it will be unknown. Let me put it that way. It will be unknown when you have not concluded the financial or the reporting. So it will not be declared at the end of the year when you have recognized what the profit is all about, before you now go to the policy that talked about what will be the portion that you are going to pay out as dividend and what will be the portion that you are going to retain as profits, as retained earnings. So DPS.
It measures, it indicates how much dividend is paid per share.
Indicates how dividend is paid per share. So if you're having increase in dividend per share, what are you going to give as justification? Difference in your dividend per share. What will be your comment, Chiamaka? Chiamaka, you answered the question and you run away. And it's a lovely answer, to be sincere with you. You are correct. So I just need your interpretation. Daniel, you want to bail her out?
No, I want to just ask for clarification. The EPS and DPS, we are talking about number of ordinary shares here, shareholders here. So I was saying that the earnings relates to retained earnings or dividends relates to dividends. Clarity, sir.
Yes. Number one, for the earnings, for the EPS, the profit that we are referring to there will be profits distributable to ordinary shareholders. Profit distributable to ordinary shareholders. So while that earnings per share will be related purely to the earnings, which is to the equity holders, while that of the DPS will be related to dividend, which is the dividend holders. And under the dividend per share, so the higher the return, the higher the dividend, the better for the shareholders. That means they are getting more yield on their dividend on each numbers of ordinary shares that they invested in the organization.
Thank you, sir.
You are welcome. Dividend yield.
Hello, sir. What's the question you asked me? My network is
Okay. So give us any interpretation to any of these stock market ratio. That is the question. Under stock market ratio, somebody has given an explanation on earnings per share. Another person gave an explanation on DPS. So we have 4 more: dividend yield, dividend payout ratio, price earning ratio, and dividend cover. So that's the question.
Okay, I was asking because I'm the one that gave the explanation for DPS, but you asked something before network tripped. You asked me something after I gave the explanation. So
Okay. So the question that I asked was that you gave the explanation. Then my question now said that if the earnings per share increases, what will happen to the shareholders? Or what will be your comments? What will be your decision for increase in earnings per share? That was the question. Chiamaka? Is that clear? But we have answered that already. Yes. So the more earnings per share, the better for the investors. The same thing is applicable to the dividend per share as well. The more or increase in DPS, the better for the shareholders as well. Dividend yield. Mercy. Dividend yield.
Sorry, sir, I did not lower my hand before.
Your hand was up. Okay. All right. Okay, don't let me waste our time. since I've given us this as part of our take-home assignment, it is possible that because it is long that we have worked on it, and at your skills level, most of these questions, examiner pay more attention to the calculation, to the formula and the calculation than the decision at your skills. In fact, at skills level, they may not even ask you to make decision. But at this stage, what you needed is what is the interpretation. Then the fourth one I quoted on that material is on gearing ratio. And gearing ratio comprises of what?
So I just wanted to say, will I be right to say that the dividend yield is the explanation is that it's talking about the increase in the dividends as a result of good business performance within a particular business year. For that reason, the increase has increased, and that will create a benefit to the shareholders.
Yes, you are correct. So you are relating dividend yield to two options. The first one, it is when if there is low yield, that is, if there is decrease in dividend yield, so the company will retain a large proportion of profit in order to do what? To reinvest. That is, the company will be retaining much proportion of profit and pay what? And pay lesser dividend. But when the dividend yield is high, so that means it will be very risky because that will affect the growth of the organization. It will affect the growth of the organization, which means the company will be paying more of dividend out than paying little, so that they can reinvest in their what? In their retained earnings. Do more research on that. Yeah, correct. But do more research. So gearing ratio, debt and gearing ratio.
Debt to equity ratio.
Plus long-term debt.
You have debt to
equity ratio.
Equity ratio.
Then we have gearing ratio.
Formula it for me.
Okay, debt to equity is total debt divided by shareholders' equity.
Total debt divided by
shareholders' equity.
Then the next one.
Debt ratio.
What do you say?
Debt ratio. Debt ratio.
Debt ratio.
Debt of
and this is what?
Total liabilities divided by
which is this total liability divided by what?
Total assets.
Divided by total assets. Any other one?
This one is smaller.
Interest cover.
Yes, somebody mentioned it before. Interest cover ratio. Interest cover. And this will be what?
Profit before interest and tax over interest or finance cost.
Over interest or finance cost. Or finance cost. Okay. So please don't forget my assignments to be submitted on or before Wednesday. So let's see if we can still move a bit going by our slide. So that is that on the ratio analysis. And let us look at the uses of ratio analysis. The key to obtaining meaningful information from ratio analysis is comparison. That's what we want to do. Compare. Comparing ratio over time within the same business to establish whether the business is improving or declining. And comparing ratios between similar businesses to see whether the company you are analyzing is better or worse than average within its own business sector. So within its own business sector, we are referring to business in the same operation, maybe a transportation business. And transportation can be road transportation or rail transportation. Okay, rail is still part of road transportation. Then we have air transportation, airline. So you can compare these two between any sector that are related. So you can make your comparison between businesses within the same line of operation. So a vital element in effective ratio analysis is understanding the needs of the person for whom the ratio analysis is being undertaken. The users, that is the purpose. Investors will be interested in the risks and return relating to their investments. So what type of ratio that is related to investors? We have the profitability ratio. We have part of it to be under the liquidity ratio. You have some of them under the efficiency ratio as well. Suppliers and lenders are also interested in receiving the payments due to them. So we'll want to know how liquid the business is. So with suppliers, once they have your financial statements, they can carry out your payable period. With that, they can make their own decision if your business will suit their own business as well. So if your repayment period is so high, they will compare it with what their own capital float is to know if they can be part of that your business or not. Managers are also interested in ratios that indicate how well the business is being run and also how the business is doing in relation to its competitors. You don't want to go to business that are not improving, that are not growing. So part of the insight, in fact, some of us, when you go for an interview, the interviewer will ask you, why did you have interest in our organization? Part of your answer mostly is because of what you are leaving the previous business because of growth. And if the HR want to kill you, they will not say, then why can't you stay with that business and also improve in that business to help the business to grow? Why is it the business that you now see that the business is growing and that is the one that you just want to take? So if you are not smart enough, you may be asked to go home and they will tell you that we'll get back to you if you don't have a mind-blowing answer to that. So managers are interested in ratios that indicate how well the business is being run and also how the business is doing in relation to its competitor. So from that, managers will look at mostly the investment ratio. In fact, they can also make use of make use of in the financial statements. You look at the statements relating to human resources. You look at the staff turnover period. That's another indication. Staff turnover period. How often did they change employee? That doesn't mean that the company is not having a job security, among others. So trends. Aside from ratio analysis, we have trends analysis. The trend analysis, this one you may only be used in your case study scenario, although you make use of ratio analysis as well. But in practical, in exam context, you may not be given ratio on trend analysis, comparison on trend analysis. If you are to have trend analysis, the trend analysis is not that so vital unlike that of the ratio analysis, because the trend will just give you a financial summary for a specific period of time, indicating the profit, the income statements and overview of the financial position. So the use of trends is a popular method of assessing corporate performance. You will notice in most published financial statements that the previous year's figures, as well as those for the current year, are included. So if, in fact, it's part of what you and I are doing in our monthly financial reporting. So you carry out a variance analysis, not only on a yearly basis, in fact, on a monthly basis. You do a trend analysis, previous month's report with what? With the current month report, to see where you are having differences and the causes of those differences, and what will be the appropriate steps or decision to be taken in order to go out of any of the issues identified. And this will allow users to quickly spot significant changes. You can see this will do what? This will allow users to quickly spot significant changes in such major financial categories as non-assets and revenue. In addition, 5-year financial
The mic is muted. We can't hear
Who mutes
anything.
me? I don't know who mutes me. Allow me to finish my class. It is my class.
It's 5 for it. Maybe that's why.
Hold on. Let me round up then. So in addition, 5-year financial summaries are often provided towards the end of annual reports, which means that trends can be identified easily. Dear professional colleague, today we have introduced ourselves into the syllabus that we are going to be using for this diet. Don't be panic. In fact, I can make it more easier than before. But don't go and use that to scare your junior one at the skills level that all our burden have been shifted to the skills. So you are the one that will be battling with it. But they will also have a soft landing, because we have identified the key areas that they need to be prepared for. So thank you all for your time. Do not forget my assignment. I gave us 2 assignments. Somebody should paste the second assignment for us on the WhatsApp group, which is to be submitted on or before Wednesday, close of business on Wednesday, for me to assess and also send you a suggested solution. Essay, Sunday Ajayi, your hand is up.
Yes, sir. I just good evening, sir. I just want
You're
to know
welcome.
I just want to know the time frame that the lecture notes will be updated and it will be made available to us. Thank you, sir.
Latest, we are in month of July. Today is 12th of July. So latest by end of July, latest, you are going to have it, the fully updated one.
Okay, sir. Thank you, sir.
Sir,
you are welcome.
Sir, please, we have another class now.
You said what?
I said that we have another class right now.
Okay, I will release you all now. David.
Okay, good evening, sir.
You're welcome.
Okay, sir. Are you to send it to your own personal WhatsApp?
Don't worry, just give me between today and tomorrow. I will log into my LMS. After logging to my LMS, I will share you where you are going to send the solution. I will send you where you are going to, so that we will not overcrowd the WhatsApp group. So thank you all for your time. See you same time next week. Do have a wonderful weekend.
Thank you, sir. Thank you, sir.
Thank you, sir, for your time.